Let's bring in Eric Robertsen, Global Head of Research at Standard Chartered Bank. He joins us from Sydney. Eric, great to see you. So Jay Powell and the committee really seem to be at odds, don't they, on the taper timeline? Does that underline almost the global dilemma that central banks are facing, which is Delta on the one hand, a lot of inflation noise on the other, really complicating the policy path?
Good morning, Sri. I wouldn't say that there's too much conflict at the Fed. I think they're trying to express a range of views. I think Powell said it extremely well. If everything goes according to plan, they could be in a position to taper by the end of the year. For us, that means November announcement and proceeding in December. I think it's absolutely correct to say that they are tiptoeing or navigating a communications minefield, but I think they're doing a pretty good job of preparing the market and getting the markets ready for a pre-year-end announcement.
Got it. Eric, then is that scenario largely priced into the rates market, priced in to dollar, and more pertinently for us, are we ready?
Well, I think it is priced in, Sri. I think if you look across the U.S. rates curve, there's effectively nearly one hike priced by the end of next year, and that assumes a fairly steady pace of tapering throughout the year, and then a subsequent couple of hikes in 2023. So I think the U.S. rates market is very well prepared. In terms of emerging markets and in our neighborhood here in Asia, look, EM has underperformed this year across a number of asset classes. Part of that is growth uncertainty, and part of that is also the elephant in the room of Fed tapering. And so I think that, the good news is we're not going into this tapering scenario with emerging market assets at, overvalued levels or investor positioning at historical highs. So I would say that we are fairly well prepared.
That said, the IMF said EM Asia cannot afford a taper tantrum. There really does not seem to be much room for error, does there, Eric, especially when you consider these yawning deficits across EM?
Well, I guess with all due respect to the IMF team, in some ways, I think they're correct. We can't afford another taper tantrum, but I think in many ways we've already had that. We had a big move higher in U.S. rates in the first quarter of the year, and it's our contention that that was the taper tantrum. Now, the good news for EM is comparing today to 2013, investor positioning is much lower, and more importantly, in our opinion, these deficits, which are correctly discussed, are in much better shape today than they were 8 years ago. So from an economic point of view and an external vulnerability point of view, I would argue that EM is less vulnerable today, even with the overhang of the COVID uncertainty.
EM assets are attractive, Eric, you say, but they're cheap for a reason. And isn't it almost akin to catching the proverbial falling knife when you consider the outlook? It just looks so fragile. On the deficit side, you've got political risk. Yes, Afghanistan is an extreme example, but you're seeing political risk unfold in places like Malaysia, food price inflation, and then, of course, third and fourth waves in so many parts of EM Asia.
I think there are certainly risks, Sri, and there are certainly challenges. The question that we have to ask ourselves is what is in the price? If you take emerging market equities, for example, they're currently trading at a little over a 40% valuation discount to the S&P. Does EM have its challenges? Yes. Is it worth a 40% discount? We would argue no. Now, a big part of that is the recent underperformance of Chinese equities, largely due to the regulatory concerns, et cetera. But even markets like Korea, where we would argue the economic outlook is reasonably good, the Bank of Korea has just raised rates for the first time, and we think is on target to do so again before the end of the year. And so I think there are a number of economies and markets in Asia, especially where you are seeing the tide turn on COVID. You're seeing the tide turn towards a bit of policy normalization. And I think the growth outlook is actually pretty good. And over the last couple of days, we've seen a number of these more pro-cyclical assets. You mentioned Malaysia. Right. The Malaysian currency has recovered a bit. So I think the recovery story in Asia is in some ways underappreciated by market pricing here.
Yes, I hear you, Eric, and the path of the post-pandemic recovery was never going to be perfectly linear, but I can't help but feel when you have the BOK raising rates, that might be premature, given just how dynamic this pandemic is and continues to be. Shouldn't they be operating out of an abundance of caution?
Well, there's two ways to look at that, Sri, and I hear your point. The first of which is if we were looking at monetary policy around the world and the policy setting being at neutral, and we were talking about central banks raising rates into restrictive territory, then I would certainly agree that that would be premature. But in Korea's case, and I would argue for a number of the other central banks that have or are looking to raise rates, they're going from historically exceptionally loose monetary policy and just trying to dial that back a little bit. And I think that's important. In Korea specifically, they're dialing back their monetary accommodation, but they're still running fairly loose fiscal policy. So you have to look at the two policies in combination. And I think that that's an important first step for Korea.
To what degree does Delta, Eric, third and fourth waves, does it change the narrative meaningfully for markets, for investors, and the policy path?
I think it has. I think you're absolutely right. And we saw that a number of months ago in India, and we're still seeing the legacy of that recent wave with regards to policy. The RBI has made it very clear that even with the improvement that we've seen, their priority is economic growth. And even with the Fed over the weekend at Jackson Hole, you heard Jay Powell say we've seen a significant improvement in the labor market, but the unemployment rate is still too high. And that's a reference to structural unemployment, which is a topic that every major economy is going to be faced with. And so I think the policy trajectory from here is one of caution, as you say, but I also think that in some cases, they need to start dialing back some of that excessive monetary accommodation that has been put in place.
Eric, just a quick short-term question. We've got August payrolls out on Friday, of course. Are we going to see Delta's fingerprints on this data set? And what do you reckon that does to risk appetite, if so?
Well, I think there's probably some direct and also some indirect effects in terms of payrolls coming up. The direct effect is, as you say, maybe Delta has had a short-term impact on hiring. Maybe it's had a short-term impact on people's willingness to go back into the workplace. The more indirect effect, and this is something that will start to play out over the next few months, is that a number of the emergency unemployment measures which the government offered at the peak of the COVID crisis are starting to expire over the next few months. And we would argue that that should start to have an impact on the labor market as well. All of that said, it's going to be noisy. We're looking for a slightly less than consensus payroll print. We think the risk is somewhere around 500,000 or 600,000 monthly jobs rather than the 8 or 850 that we've seen over the last 3 months. So perhaps a tiny bit of downside risk to Friday's number.
Eric, excellent as always. We'll leave it there, sir. Thank you very much indeed for joining us this morning. Eric Robertsen there, Standard Chartered Bank.